Most business owners are drowning in metrics that don't matter and not tracking the few numbers that are actually going to help them grow their companies. I learned this the hard way. In my first business, I was stuck at like $9,000 a month in revenue for almost 2 years before I figured out exactly what I needed to measure in order to finally unlock the next level of growth. In this video, I'm going to answer one question. If I could only pick 9 metrics to grow my business forever, which 9 would they be and why would I choose them? So here's the thing about metrics, right? Most business owners I talk to fall into one of two categories. They're either measuring 1,000 pieces of data and they still have no idea which ones are important, or they've kind of given up and they're not measuring anything and they're just running on gut feel. Neither one of those works. So as we walk through the answer to this question, I'm going to give you a few things. The first thing I'm going to do is teach you the 9 areas of your business that you need to make sure you measure every single week forever. Once we've got the model laid out, I'll show you which 9 metrics I would pick, one for each area, and then from there, I'll give you some next steps if you want to go deeper. Every business needs 3 things in order to live. They need to get new customers, they need to help those customers win, and they need to make money so you can reinvest in getting customers and helping customers win, and hopefully make some profit and live a cool life. That's a business at its core. Now within each of these 3 main functions, they have 3 specific areas that I like to measure. We'll start with getting customers. You've got to do 3 things, right? You got to get attention in the market. You've got to be able to do what we call demand generation, which is taking leads and turning them into sales discussions. And then of course, you got to be able to sell. All right, now let's talk about helping customers win. Any business on earth has to do 3 things. First thing you got to do is get your new customers that you just sold to their first value moment as quickly as possible. But the job's not done because then you've got to make sure they keep winning over time. And last but not least, when they raise their hand and ask you for help, you got to make sure that you're delivering it at a world-class level. And now for this third row about actually making money so you can reinvest into the first 2. Every business, I strongly believe, needs to focus on social proof, getting your winning customers to tell their stories to the market, because not only does it help you build a brand, but it makes everything else you do less expensive. From there, you gotta make sure you're building a happy, healthy, and engaged team, so that way you can achieve the goals that exceed what you can do by yourself. Last but not least, you gotta know your finances, and we'll talk more about that one at the end. Now, honestly, every single one of these boxes on my iPad could be an entire 30-minute video, but the purpose of what we're doing here today is to figure out the bird's eye view. And so like I said in the beginning, I'm gonna answer that one question. If I could only pick one metric for each of these boxes, which one would I pick and why would that be the one I choose? And we're gonna start right here at the top of the funnel about getting attention in the market. So if I could only measure one thing to track my ability to get attention in the market, it would be my blended audience size. Now for each of these metrics, I'm going to give you a definition. This one probably feels straightforward, right? It's just the sum total of all your business social media accounts, your personal social media accounts, your email list, and any other marketing assets that you're tracking and growing week over week and month over month. On that topic, if this feels a little basic, I'd love to challenge you for a sec. Every one of these metrics I'm gonna roll through today in this video, you need to be tracking in some type of scorecard or spreadsheet every single week. So if you look at something like blended audience size and you're like, oh, that feels super basic, just gut check yourself real quick. Can you tell me exactly what your blended audience size is as of today? Do you know how much it grew in the past 7 days and the 7 days before that? Is it growing more or less than normal? What do you want it to be at the end of the month? Like, that's what I'm talking about when I say, are you measuring a metric? So if you're not hitting it with that level of discipline, that's really where we need to start before we go measuring 1,000 different things. Now, the goal for this metric is probably pretty obvious. You want to grow it as much as you can so that way you can reach more people out in the market. What you're gonna find with these high-level metrics is that a lot of the time they're great for kind of a pulse check on how is this function performing, but they're not detailed enough for you to actually diagnose a problem and solve a problem. And so for each one of these metrics, I'm also gonna give you a breakdown, right? Like how can you take the aggregate metric, in this case, blended audience size, and kind of divide it up or double click into it to figure out what's driving your growth and where you might be getting held back. Now for this one, you just want to break it down by channel. So for example, if you've got 5 social media accounts and an email list that are all rolling up into this blended audience size metric, you can break those out on your scorecard and track each one of them separately. Track them the same exact way, right? What are they today? How did they grow last week? Where do I want them to be at the end of the month? Now at scale, you're probably even gonna have a person handling each one of those channels and they'll be accountable for their growth. But regardless, you just got to be able to look at each of them individually, find the problem and fix it, so that way you'll know what's driving the movement on on your blended audience size. Now here's the thing you'll realize as we go through this is that each of these 9 metrics drives the next one. So for instance, you could be doing an incredible job getting attention in the market and growing a huge audience, but if you don't have a really solid demand generation function, it's not gonna turn into sales, and that's what we're gonna cover next. So when it comes to demand generation, there's a lot of stuff I'd like to measure, but if I only got to pick one thing, it's my lead to call conversion percentage. Here's the definition. This metric answers the question, what percentage of the leads that I'm getting in a given week or a month are turning into sales conversations? You can adjust this for your business. If you're a software company, it might be demos or free trials, right? If you're an agency, it might be introductory calls or discovery calls, but whatever that very first sales interaction is, that's what you want to track. What percentage of my leads are setting up into those first sales conversations? It's a really simple math formula. You just take the number of new sales calls created, or whatever that interaction is for you, and divide it by the number of new leads generated. That's going to give you a percentage, and that's what I would track every single week and every single month. So the goal for this, of course, is to increase the number of sales conversations that you have. And if you want to break it down, just like we did on the attention metric, just break it down into channels, right? Because you might have leads that come from paid ads that are going to convert differently than leads that come from referrals or that come organically through your website. And eventually you're going to want to be able to see how each of those channels is performing in order to figure out which one's lagging behind and which one you should probably put some more money into. But again, if I can only measure one thing, I'm just measuring the percentage. All right, so when it comes to sales, a lot of people think you should measure like how many sales did we get, or what's my close rate, or how much money did we make. And look, you're probably gonna measure all that stuff anyway, and it's fine. But if I could only pick one thing, I would be measuring a metric that you probably aren't tracking called sales velocity. Now, the definition of this is it's one metric that doesn't just tell me, are we closing deals or how much money are we making, but how quickly is the sales team generating revenue? And that's a really powerful question because speed makes you money all the time. Now let's walk through how this thing works because it's a little more complicated than the two we've been through so far. All right, so to track sales velocity, let's say we're tracking it for a given month, you need 4 things. First thing you need, and write this as we go, is the number of deals that you had in the month. You're gonna multiply that by your average revenue per account, or ARPA. I'll talk more about that in a sec. You're gonna multiply that by your close rate as a percentage. You're gonna do all that and you're gonna divide the whole thing by your time to close. All right, let's define some of these so we're doing this the right way. And then I'll talk about why I love sales velocity as a metric and how you can engineer it to help you figure out what your problems are. So the 2 things that are probably not that obvious. Average revenue per account, right? So all this is, if you take all the deals that you closed over a month, right? Let's say you got 3 product lines and one of them gives you $500 a month, one of them is $1,000 a month, and one of them is $2,000 a month, right? Let's say that you closed 5 deals at 500, 3 deals at 1,000, and 1 deal at 2,000, right? So 5 at 500 would be 2.5K, this would be 3K, this would be 2K. If you add all that up, it's $7,500, and you divide that by 9 because that's the total number of deals that you had. Not smart enough to do that one in my head, so we're gonna go with $833 per month is your average revenue per account. All right, so you're just averaging basically the monthly deal size of everything that you closed. Your close rate, pretty simple, right? It's how many deals did you close? Let's say we closed these 9 deals. Out of, maybe we conducted 27 sales calls. So, right, 9 out of 27, that would be a 33% close rate. All right, so we did average revenue, did close rate, number of deals is pretty simple, and time to close, I measure this as the number of days in between the sales interaction getting booked and when money actually changes hands. That's just a measure of days. Those are the 4 things that you need. So for this example, let's say our average time to close was 30 days. So now we're actually gonna do this math. All right, so I closed 9 deals at an average of 833 per deal, and my close rate was 0.33. I'm gonna put that over 30. So that would give me a sales velocity of, pause while I do this math, 82.47. Now, doesn't actually matter what this number is. What matters is what direction it's going, right? A lot of these aggregate metrics, these metrics that take 2 or 3 or 4 or 5 different things and do some math to get you a number, it's really tough to benchmark, and it doesn't actually matter what the number is. It's all about the trend. So let's go through some examples. We're trying to get this number to go up, all right? So let's say nothing changes except the number of deals. Let's say we do 11 deals instead of 9. Obviously, we know that closing more deals is better, but this lets us measure, right? It takes our sales velocity by changing that one number from that 82.47 all the way up to 100.79. All right, we'll erase that bad boy for a minute. Now let's say again, one number changes. Say we sold more of the higher level offers instead of more of the lower level ones, and our average revenue per account went up to 1,000 from 833. Nothing else changed. This would bring our sales velocity from 82 right up to about 99. Next example, let's say your close rate goes up, right? So you close the same amount of deals, but your close rate was higher, which means you needed less sales conversations on the front end to get the same result. Let's say maybe you've got a 0.4 or a 40% close rate instead of 33. That would also bring this up to about 99. I think it's 99.9. So we'll call it 100. We'll round that bad boy, right? But you get the idea is if you close more deals, it goes up. If the deals that you close are more valuable, it goes up. If you close a higher percentage of the deals, that means you're being more efficient, you're a better sales team, it goes up, right? Now, denominators, for the people who aren't math nerds, the number on the bottom of a fraction, they work the opposite way, right? So this number needs to go down in order to make sales velocity go up. Do a quick example. Let's say instead of taking 30 days to close, it takes you 21 days to close, right? So you take a full week off of your sales process. Let me do that math real quick. Your sales velocity in this case would come out to 117.8. All right, so number of deals goes up, you win, value goes up, you win, close rate goes up, you win, time to close goes down, you win. So the great thing is, if you see your sales velocity declining week over week or month over month, you can come in here and pop the hood and figure out, what is my problem? Are my reps not closing? Are we selling cheap stuff? Are we not getting the deals done? Or are we taking too long? And no matter what it is, it's gonna point you at one of these 4 core areas in your sales process in order to figure out how to fix the problem and get your sales velocity up and to the right. Now, just like all the other metrics, I give you one way to break it down. This one's a little different. If you're running a sales team, I like to break this down by person, by sales reps. You can actually measure individual sales velocity for each salesperson. You can figure out who's closing deals fast, who's closing them slow, who's selling big ticket, who's selling small ticket, who's closing deals at all, right? It's a great way to measure this. You can break this down by individual rep and track it over time. That's what I like to measure for sales. That pretty much covers this whole first row, right, of getting customers, attention, demand generation, and actually getting the deal done. So now let's shift gears and talk about how we actually help our customers win. And it all starts with getting them activated to that first value moment as quickly as possible. So when it comes to helping your customers win, I always start with one key metric on activation, and it's activation rate. So we'll define this real quick. It's how many of your new customers get to their first value moment on time. And that last part's the key. But before we talk about this, let's roll through exactly what I mean by first value moment. So measuring whether or not a customer is getting their first value actually has 3 components to it. A lot of people do this the wrong way, so pay attention. The first is knowing what the actual first value moment is, right? Like in my first company, UpLaunch, we were a marketing platform for gyms. So our first value moment was when a client gym of ours got somebody who is not their customer and turned them into a customer. You get that first client through the platform, that's first value, right? It's gotta be something that is absolutely black and white, binary, a 0 or a 1, it happened or it didn't happen. So when you're figuring out this first value, you've got to define it and make sure that everybody on your team can define it the same way. Once you know what it is, the next step is defining when it needs to happen. Think of this like a deadline, like some kind of project, right? If it's a timeline here from day 0 when money changes hands, say maybe it's 14 days, this is your deadline for getting first value. If it doesn't happen on time, it's not what I call a successful activation. The thing has to happen, and it has to happen in an appropriate period of time. And last but not least, you gotta know how you're gonna measure it. right? If you have this thing and you're like, I think it happened, I think they got the result they paid me for, but I'm not really sure, and I can't measure it, that is a problem. Even if it's self-reported, even if you have to talk to the customer, like whatever it takes to be able to measure whether or not this thing happened, the reality is that your entire retention as a business hinges on your ability to get the customer to first value really, really effectively, really, really fast in a place where they're really, really happy. So it's worth putting a ton of time and effort into this initial interaction. What is it? When does it need to happen? And how are you going to measure it? Once you have the answer to all three of these questions and they're all true for a customer, they got the value, it happened on time, and you can measure that it actually happened, that's what I like to call an on-time activation. Right? The customer came in, they got what they said they would get, when you said they would get it, and you know that it happened, check, on-time activation. And once you have that, then you can measure your activation rate. Formula for activation rate, once you've done all this work, which is the hard stuff, defining first value, formula for activation rate is really simple, right? It's just your number of on-time activations divided by your new customers in activation. And I'll explain what I mean here. Let's say that, I'm gonna do this really simple numbers to make it easy, okay? Let's say that your timeline is 30 days, okay? And in this prior month, in month 1, you sold 10 new customers. That would mean that over here in month 2, you've got 10 people who are in activation, right? You've got these customers who should be hitting their first value moment in that second 30-day period. The activation rate, let's say 8 of them got there, right? Which means 2 of them are sad. 8 of them got there, 8 out of 10, it's 80% activation rate. The goal for this, the whole reason we care about this, is to increase customer satisfaction and reduce churn, meaning the customers that quit. You want to keep people in your world. The reason we care about this is really simple, because you want to improve the retention in your business. If you go all the way back up here to getting customers, you have to remember one thing. You're spending a whole bunch of money to do this, and it costs a whole lot less money to keep them in your world than it does to bring them in, let them leave, and go find new ones. And the first step to nailing your retention is getting them to first value so they are fired up in their first 30, 60, 90 days, and they're really, really happy to be part of your world. But it's not enough, because even if you get that early win and then it starts to tail off, they will still leave. And so the next thing we gotta focus on is how to make sure that they keep winning over time. And that's what customer success is all about. So there's only one thing that I like to measure when it comes to figuring out if my customers are winning over time. And it's this thing called a customer health score. It was actually pioneered by Dharmesh Shah, the CTO of HubSpot. He called it a customer happiness score, but the thought is the same. You can define this as a score that measures how likely your customer is to stick around if you give them the opportunity to leave, right? So if they're at a renewal period or a month-to-month contract. This one's tricky. All the other metrics that I've walked through in this video so far have a specific formula that you can use to calculate them, but this one, it's really just measuring on a point system. So I'm gonna show you on the iPad what I'm talking about here. All right, so to calculate a customer health score, what you wanna do is think over a few months of usage of your product or your service, what are the behaviors and actions that you want your customer to be taking? I like to use software examples because that's where my background is, so I'm gonna give you one here. So let's say when I map out my desired customer behaviors, I want them to do really 4 things. I want them to be logging in every single week. I want them to be using feature A, right, one of the main features of the platform, at least once a month. Same thing with feature B, I want them to use that at least once a month. And then I want them to attend a customer webinar at least once a quarter. So you see I kind of articulate these as questions, right? Like, have they logged in, have they used the features, and have they attended the customer webinar all within the prescribed periods of time? These are all things that even with a simple spreadsheet and a little bit of looking around, you can track for your customer base over time. And what I did here is I assigned them all a points value. In this case, for this example, I weighted all of them equally, 5, 5, 5, and 5, which means you've got a total possible points value of 20. Right, now let's say they haven't logged in the past week, so they get a 0 up here, and they haven't used this feature, they get a 0. They have used this one, they get 5, and they've done the customer webinar, so they've got 5. So obviously that would be a customer health score of 10 out of 20. Now, I like to normalize these on a 0 to 100 scale because it just makes things a little bit easier. So it's the real formula for this is just the number of points that they got when you total up their score divided by the maximum possible number of points, right? So 10 divided by 20, I would rate this customer health score as a 50 out of 100 or a 50%. Now, this is a good starting point, but as you go through this exercise month over month and quarter over quarter, you'll eventually start to realize that maybe some of these behaviors are more predictive for retention than the other ones. And so where this gets really cool is you can start to weight these scores differently. Like, let's say feature A is really, really freaking important. So maybe instead of giving that 5 points, you give it 10 points, right? And so now you've got a max number of points is 25 instead of 20. You can start to play with the weights. And over time, as you iterate, as you mess with this thing, quarter over quarter, year over year, you'll start to get better and better at correlating your customer health score with their likeliness to stick around. And once I have the scoring done for all of my customers, I like to build a dashboard. I love a good dashboard, and I'll break this down into greens, yellows, and reds. My goal, of course, is that I want as many greens as possible, and then I invest some time into the reds to try to get them to yellow, and I invest some time in the yellows to try to get them to green. We increase the health of our customer base, we'll increase the retention, we'll be able to expand their lifetime value, and build a bigger and more profitable business over time. Now, if you want to go a little bit deeper on this, once you get customer health scoring installed into your company, you can start to break it down a number of different ways. Like if you've got different types of customers, maybe you serve software businesses, agencies, and consultancies, you might break it down by their industry, or you can break it down by product line, all sorts of different ways. But if you want to get that granularity and get a health score for each different slice of your business, you can absolutely do it that way. So now that we've gotten through activation and first value and customer success with this health score, you've got everything you need to make sure that people are getting what they think they've purchased once they get into your world. But there's one last element of making sure your customers win, and it's one that most companies undervalue the most. The last important part about helping our customers win is customer support. For whatever reason, so many companies think this is some entry-level trivial task that should be, doled out to the most junior person on the team. I absolutely disagree. In my first company, our entire culture was built around customer support. Every single person from C-suite all the way down to the most junior person on the team all participated in the live chat to support our customers, and we took a ton of pride in making sure that they got the answers they needed as quickly as humanly possible. The metric I'm about to teach you is one that I tracked every single week for the entire life of our company, and that metric is what I call support CSAT, or Support Customer Satisfaction Survey. Now, in order to pull this one off, you are probably going to need a little bit of help from software or a process, but the big idea here is that every time your customer raises their hand and asks you for help, once that interaction is completed, you're going to find out if they're happy with the help that they received. And this can take a lot of different forms. They might think it was fast or slow, they might think it was complete or incomplete, they might feel happy that they got the info they needed or not. But the big idea here is that regardless of the cause, you want to just find out, how are they feeling? Are they happy with the way that you met their needs when they put their hand up and asked for help? The formula for this is just an average, right? Different support softwares and methodologies track it differently. Sometimes it's a green, yellow, red. Sometimes it's a 1 to 5 or a percentage-based score. But either way, all you want to do is however you're tracking the customer happiness after the support interaction, you get the average of all of those replies on a rolling 30-day period, and you report on it every week. By doing this on a rolling period, it's going to give you a trend line that moves up and down regardless if you have a lot of support interactions or only a few. And it's going to tell you the overall average happiness that your customers have when they talk with your team. Customer support's an interesting one because the goal for it really branches into a few different areas. Like, yes, having great support is going to improve retention. Yes, it's going to help you get more social proof, which we'll talk about in a minute. It's also going to improve your customer health scoring because they're going to be happier and using more features because you're telling them how. Right? So having great support is kind of like the foundation of the house. Without it, your customers are going to get pissed off because eventually they're gonna need your help. So if you wanna break this down and get into a little bit more detail, there's two ways that I do it. The first is by looking at the actual support cases. Like if I see the average CSAT start to go down, I'll start to pull the cases and figure out why. Like maybe there was a bug that really made a lot of people mad, or maybe we didn't answer the phone in time, or maybe we didn't reply or close out the support case fast enough. But I'll usually go try to find the reason why people were less happy with the support over time. The second one, from a data standpoint, is the same as customer health scoring. If you have multiple product lines, you can break it down that way. If you have customers in multiple industries, you can break it down that way. But this one's also really interesting. You can break it down by the team member. So in addition to having like customer-wide CSAT after a support interaction, if you've got 5 different people who are answering support tickets, you can also break down personal satisfaction for everyone that's interacted with them, and then you can start to see which people are giving the best service, which ones might need some coaching, which ones might not be able to talk to customers. All 3 of those are real things. So now that we've covered the 3 big things that we got to do to help our customers win, we're going to get into the last row of this model. How do we make sure the business actually makes money? And the first one is not the obvious one you might think. So the first step to running a more profitable and financially healthy business has nothing to do with money at all. It's all about getting social proof in the market. Now, what do I mean by social proof? I mean getting your customers to tell their stories of how they won because of their relationship with your business. The reason I put this where I put it in the model is because when you have an army of happy customers telling their stories out loud to the market, it makes everything else easier, cheaper, and more effective. Your marketing will get better. Your sales will become easier to close. Those lighthouse customers will help your new customers win, and your overall customer health score will go up. Social proof is critically important. It's chronically undervalued by a lot of companies, and it's something that every single business on earth should be focused on. Now, you might think that I would want to track things like how many case studies did we produce or how many testimonials did we get, but if I can only pick one metric for this, I'm not choosing any of that stuff. Like, that stuff's interesting and it has to happen, but what I'm more interested in is going upstream and figuring out what can I measure to gauge how likely my customers are to give me that social proof in the first place. And the tool that I use for this is something called a Net Promoter Score. Now, a Net Promoter Score is simple. It's just a 1-question survey that goes out to your customers, and it says, how likely are you to recommend this business to somebody else? I like to send it every 90 days, and I measure the score on a rolling 90-day basis. Now, here's the thing about Net Promoter Scores. They rate the answer to this question on a scale from 1 to 10. But they break down the respondents into 3 categories. Break out the old highlighter here. Anything from a 1 to a 6 is what we call a detractor. It's in red. Anything that's a 7 or an 8 is what we call a passive. And anything that's a 9 or a 10 is a promoter. Now, the whole thought process when you calculate a Net Promoter Score is that you're just taking the percentage of promoters minus the percentage of detractors. Now, all the people you think about when you answer these questions, so many people love to use a 7 or an 8, right? Because they're like not super pissed off and angry at what you're doing for them, but they're also not blown away, haven't knocked their socks off. But the beauty of a Net Promoter Score is that it completely ignores all of your customers who are riding the fence, and it positions this as one of 2 outcomes. You are either delivering a world-class satisfaction or you're failing, and that's it. The Net Promoter Score is ranked from -100 at the worst to +100 at the best. World-class companies like Apple are usually in the +70 and up. A lot of companies can still exist pretty healthily in the 20 to 30 range. If you get to 0 and below, you might be in trouble. Now, you might be asking yourself, cool story, but how does this pertain to getting social proof? I'll tell you. And I ran this exact play in my first company, and it was one of the coolest things we ever did. Net Promoter Score, especially when you are a promoter, you rank this as a 9 or a 10, it's a beautiful leading indicator to show you that someone is willing to produce a bit of social proof for you, a testimonial or a case study. So in my company, the way that I architected this was with a little bit of automation. Let's say they became a promoter, so they answered the survey at a 9 or a 10. I would have that automatically trigger a pre-written email to somebody on my marketing team to introduce them, and she would work with them to produce a written case study, right? So it was this automatic thing. We were always farming for our happiest customers. We give them the survey every 90 days. Everyone who answers a 9 or a 10 gets introduced to our marketing team to get a case study made. It was that simple. It was one automated email produced a bank of case studies for us that then we could go run ads against. We could go use them in our sales process, and it made everything else easier. If you want to break this down a little bit further, you can do it the same exact way that you did customer support, the same exact way that you did customer health scoring. Break it down by product, you can break it down by sales rep, you can break it down by type of customer. However you normally break down your customer base, you can break it down this way as well. But when you add all of this up, right, your first value, your customer success, your support, your net promoter score, no matter how you're slicing and dicing your customer base, you will be able to get a 360-degree view of how much value they're getting, how happy they are, how well you're supporting them, and how likely they are to support you back. And that is what I call a beautiful system to make sure that you're playing full out for your customers and that they're helping you grow as well. All right, so if you've made it this far, I can reasonably assume that you're interested not just in creating a business that helps a couple people, but actually scaling it. And the reality is that if you're trying to scale a company past a certain threshold, your goals are going to exceed what you're personally capable of, and you're going to have to invest time, effort, and energy into building a world-class team. And if there's one metric above all that I had to measure to see whether or not I was doing a good job at this, it would be the employee engagement score. So an employee engagement score is different than an ENPS. If you remember from the last section, the net promoter score, a lot of companies will use that same question geared towards their employees, like, would you recommend us as a place to work? And look, that's really cool. It's a good survey, it helps. But the employee engagement score takes this thing down to the next level. It's based on a 12-question framework from Gallup, and they've done this across tons and tons and tons of companies. It's actually pattern matched after Maslow's hierarchy of needs, but it's just like an employee's hierarchy of needs to figure out, like, do you have your basic needs met, so on and so on and so on. So there's 12 questions here. I'll tell you what they are real quick. How satisfied are you with your company as a place to work? That's the baseline that kind of sets the table for the whole thing. I know what's expected of me. I have the materials and equipment I need. I've got the opportunity to do what I do best every day. The last 7 days, I've received recognition or praise for doing a good job. My supervisor or someone at work seems to care about me as a person. That's a really important one. There's someone at work who encourages my development. Do my opinions seem to count? Does the mission or purpose of my company make me feel like my job is important? You can see these are starting to go from the tactical at the base of the pyramid all the way up to like the existential type of questions. Right, are my fellow employees committed to doing quality work? Do I have a best friend at work? Has someone talked to me about my progress? And have you had opportunities to learn and grow? It's a really, really powerful survey, especially when your team gets above about 12 or 15 people, because then you can actually break it down a few different ways, right? You can break this down by team, by manager, or by tenure, right? So like, are my newer people happier than the people who've been here a while? That's interesting. You know, is my sales team pissed off? My marketing team is happy. That's interesting. Are there a particular manager or a person in the C-suite or a director who's got a team that's a lot happier than everyone else? Probably guess what I'm gonna say next. Also interesting. And these are all things that should clue you in to go figure out why they're true and why they're happening and how you can either correct a problem or reproduce a really great result to a greater proportion of your team. So the employee engagement score lets you not just drill down on whether or not they would recommend it as a place to work, but why they're happy or why they're unhappy and in what area of the pyramid are you winning and losing. That's why employee engagement score is my #1 metric. All right, last but not least, the moment all you business nerds have been waiting for. We're gonna talk about finances, and I'm actually gonna break what I promised you. I'm gonna give you the one that if you really held me to it, the one thing I would measure, but then I'm gonna give you a second one because I think it's one of the most important numbers in business that every company needs to track religiously. So let's go through them both. The first one is gross margin. Now, a lot of companies, they will measure their revenue, right? How much money their customers pay them, how much income they earn. And they will measure their profit, right? Their net profit, all the way at the bottom line when all the expenses have been paid. But they don't measure gross profit, which is in the middle. Let me talk to you about how this works. So gross profit sits in the middle, right? Between revenue and net profit. So you have your revenue that comes in every month, and then you subtract your COGS, or your cost of goods sold. And what you have left over is your gross profit. From there, we'll just take this all the way down to the bottom line. This is a simplification, right? But you subtract your research and development cost, you subtract your sales and marketing costs, you subtract your other operational expenses like just general administrative, finance, people, et cetera, and then you have left over your net profit. If you're an accountant and you're watching this, cool. I know there's 47 things that probably should have been said there, but this is a pretty solid high-level primer if you're trying to get oriented. Now, here's the point I'm trying to make when it comes down to gross profit. Gross profit is essentially a measure of how efficiently you can deliver the thing that you sold. Right? So cost of goods is essentially all of the stuff that you have to buy in order to deliver the product or service. So if you're a software company, it's things like your customer support team, your implementation, your server costs, like whatever it takes to keep the software running and delivered and alive and in the hands of your customers. It's a physical products company. You might be paying for things like plastic and metal and switches and manufacturing, whatever it takes to create your widget in order to get it shipped and get it out the door. Cost of goods sold. Why is this important? Like, why don't I just care about, I make money, I run the business, and here's whatever's left? Your gross profit dictates how much money from selling the thing you'll have left over to reinvest in growing the business. So the easiest way to think about this is that your gross profit goes primarily to feed this, and then a little bit left goes here and what's left over. So if you're running a company and you are loving what you're doing and your customers are loving it and they really want more of what you have, and you want to go scale up marketing and scale up sales and put more money into R&D to build better products, and then eventually you got to start hiring finance people and talent acquisition and all this stuff. Guys, if you don't have a gross margin that spits off enough money for you to make this reinvestment, you're going to be operating at a loss, and that's going to be a problem, right? Unless you've raised a ton of money. So point being is that you will be more independent, less dependent on other people's money, less cash strapped, more profitable, more able to invest in growth if you manage to the gross profit. I really strongly believe that a healthy and increasing gross profit margin correlates very, very closely to a healthy and growing business. So that's why it would be my one pick. If you want to break this down further, if you sell multiple types of products or multiple geographies, you can break it down that way. But at the end of the day, just measure your gross profit. Set yourself a standard, set yourself a goal, find a benchmark of other companies like yours in your industry at your size, and manage to it, because it's one of those things that can get away from you, and it can be really, really difficult to walk it back once you've gone down that road. All right, now you're gonna get my bonus metric, the one that I feel is, for many self-funded companies especially, the most important thing you should measure across the entire health of the business. And it's your customer acquisition cost payback period, or CAC payback for short. So we can define this metric as the amount of time, usually measured in months, that it takes you to recover the money you spent to get a new customer. The reason this is so important, and honestly, when I first learned this, my brain broke until I figured it out, is that you can actually grow and run out of cash at the same time. And the way that you avoid that happening is by managing your payback period. So think about it. You spend a certain amount of money to get a customer. So essentially, you're underwater on that customer for a certain period of time until you recover that money, and then you start to produce profits on the account. So this little trough down here can be a problem. It's not always a problem, but it can be a problem, because if you, let's say, triple your growth, and so now you have 3 times the amount of customers down here in this trough, and then we do the same thing again, and the same thing again, and the same thing again, all of a sudden, you can have all of your free cash tied up in this customer acquisition machine, and you're not getting it back out from your customers fast enough to continue to fund operations of the company. That can be a huge problem. This has absolutely been a company killer, which is why I love to manage it. I'm gonna walk through how to calculate it so that way you can manage this in your own company. So to calculate payback period, the first thing you've got to calculate is your actual acquisition cost. And the easiest way to think about this, especially if you're doing this on a monthly basis, is your customer acquisition cost is just all of your sales and marketing spend. All right, so just everything that you have, everything that you spent in the month, divided by the number of new customers that you got. So easy math, right? You spent 100 grand on sales and marketing, all added up, and you got 10 new customers. Alakazam, you'd have a $10,000 customer acquisition cost. Once you have that customer acquisition cost, now you can calculate your payback period. So we take that customer acquisition cost and we divide it by the average revenue per account times our gross margin percentage or our gross profit percentage. Why do we do this to gross profit? It's really simple. This is why I taught you gross profit first, is because if you do it to revenue and you think you're getting all that money back, but then you immediately have to spend your cost of goods money in order to deliver the thing you just sold, it's not gonna map to reality, right? So this COGS cost, whatever it takes you to deliver the thing you're selling, you essentially have to write that off the minute you get the sale. So that's why we always do customer acquisition cost down to the gross profit level. So let's run through an example. Let's say that our customer acquisition cost is $5,000. $5,000. It takes us $5,000 to get a new customer in the door. Now the thing that we're selling them generates for us $1,000 a month in revenue. Let's say we have a gross margin of 80%, which means of that $1,000 a month, $200 of it goes immediately off the top to just create the thing that they're buying, right? So we can take this and say that it's $800, right? So it takes us $5,000 to get an $800 a month customer. So if you do the math, that means that you have a 6.25 month customer payback period. So if you do the math, that means that you have a 6.25 month CAC payback period. Again, that means that you're gonna have money sunk into this account for half a year before it comes back out. That's not bad for some businesses, like private equity backed businesses that have a lot of cash on hand. Like they can have 12-month plus CAC payback periods. But I'll tell you, if you're a new company, a self-funded company, 90 days is good, 30 days is great. 30 days you can fund your growth with a credit card. That's a really fun place to be. So the point here is that you always want to look at this. You always want to manage this number. If knowing that your acquisition money is tied up for 6 months, like if you run that out in a spreadsheet and you realize that you're going to run out of cash, you need to do one of two things. You need to increase your price. You need to get more customers for the cost that you're spending, which would decrease your customer acquisition cost, or you need to improve your gross margins, or you need to do all three. And that's how you make this number get better and how you let yourself get paid back from your investment a lot sooner. CAC payback period is the gold standard for self-funded companies, and I would encourage every single person watching this, if you're running a business, to measure this one like your company depends on it, because honestly, it just might. So look, I hope you enjoyed this deep dive into the answer to this question, right? If I could only measure 9 metrics to track the progress across any company, what would they be? I almost did it. It's actually 10 because I threw in that last one there at the end. But if you're tracking them, this is what it would look like all the way across: getting customers, making sure they win, and making money. This is what it would look like. So if you don't have a framework to track this stuff every single week, are the trend lines going up or down? Are you growing more or less? Setting goals against them. This is the kind of stuff that I do for a living, and it's the problem that I was born to solve. So you can download my metrics template that I have in the description. You can get a much more in-depth version of all the things I track across any business. And outside of that, subscribe to the channel, watch my videos.